Artificial intelligence has become one of the most influential technologies shaping the modern financial system. Over the past 2 decades, financial institutions have moved from traditional rule-based software systems toward advanced machine learning models capable of analyzing enormous amounts of data. Banks, investment firms, insurance companies, and fintech startups now rely heavily on AI to detect fraud, optimize trading strategies, evaluate creditworthiness, manage financial risk, automate customer interactions, and forecast market trends. The integration of AI into finance is not simply a technological upgrade. It represents a fundamental shift in how financial decisions are made, how risk is evaluated, and how services are delivered to customers. The financial sector is particularly well suited for artificial intelligence because it produces large volumes of structured and semi-structured data. Every transaction, payment, loan application, investment trade, and account activity generates digital records. These records accumulate over time, creating massive datasets that contain patterns about customer behavior, market movements, and financial risk. Machine learning systems excel at identifying patterns in large datasets, making them extremely valuable tools for financial institutions. One of the earliest and most widely adopted applications of AI in banking is fraud detection. Financial fraud has existed for as long as financial systems themselves, but the digitalization of payments and online banking has created new forms of fraud that can occur at massive scale. Credit card fraud, identity theft, phishing attacks, and fraudulent transactions are constant threats to both financial institutions and their customers. Traditional fraud detection systems relied on predefined rules. For example, a system might flag transactions above a certain amount or transactions originating from unusual geographic locations. While rule-based systems can catch some types of fraud, they often struggle to detect sophisticated schemes that evolve over time. Machine learning models provide a more dynamic approach. Instead of relying only on fixed rules, these systems analyze historical transaction data to learn patterns associated with legitimate and fraudulent behavior. The models evaluate many variables simultaneously, including transaction amount, frequency, location, merchant type, device information, and customer behavior patterns. When a new transaction occurs, the model calculates a probability that the transaction may be fraudulent. If the risk score exceeds a certain threshold, the transaction may be flagged for review or temporarily blocked until verification occurs. Because these systems learn from large datasets and continuously update their models, they can detect subtle anomalies that might be invisible to traditional rule-based systems. Another major application of AI in finance is algorithmic trading. Financial markets generate enormous streams of real-time data, including stock prices, trading volumes, economic indicators, corporate announcements, and news reports. Human traders cannot analyze all of this information simultaneously or react quickly enough to exploit short-lived opportunities in the market. Algorithmic trading systems use machine learning models and statistical techniques to analyze market data and automatically execute trades. These systems can process data from multiple sources, identify patterns, and place trades in milliseconds. In some cases, AI systems are trained to detect relationships between market variables that historically preceded certain price movements. For example, a trading model might learn that specific macroeconomic indicators tend to influence currency exchange rates or that particular market signals often precede shifts in stock prices. By identifying these relationships, the system can make predictions about short-term price movements and execute trades accordingly. High-frequency trading represents an extreme version of this approach, where algorithms analyze market data and execute thousands of trades per second. These systems operate on extremely short time horizons and rely on advanced infrastructure to minimize latency. Although high-frequency trading remains controversial in some regulatory discussions, it illustrates how AI-driven automation has transformed modern financial markets. Credit scoring is another domain where artificial intelligence is reshaping financial decision-making. When individuals or businesses apply for loans, lenders must assess the probability that the borrower will repay the debt. Traditionally, credit scoring models relied on relatively simple statistical techniques using limited data points such as income, employment history, and previous loan repayment behavior. Modern machine learning models can incorporate far more variables and analyze complex relationships between them. These models can evaluate creditworthiness using data such as transaction histories, spending patterns, financial obligations, and broader economic conditions. By analyzing these factors, AI systems can generate more accurate predictions about default risk. Improved credit assessment has several potential benefits. Lenders can make better informed decisions and reduce losses caused by loan defaults. At the same time, borrowers who may have been overlooked by traditional scoring methods could gain access to credit if AI models identify positive financial patterns in their data. However, the use of AI in credit scoring also raises important concerns about fairness and transparency. Machine learning models must be carefully designed to avoid discriminatory outcomes and to ensure that decisions can be explained and justified. Regulatory authorities in many countries require lenders to provide explanations for credit decisions, which has increased interest in developing interpretable AI models. Risk modeling represents another critical area where AI is transforming the financial sector. Financial institutions face many types of risk, including credit risk, market risk, liquidity risk, and operational risk. Accurately estimating these risks is essential for maintaining financial stability and complying with regulatory requirements. Machine learning models can analyze historical financial data, economic indicators, and market conditions to estimate the probability and potential impact of various risk scenarios. For example, banks may use predictive models to estimate the likelihood that a portfolio of loans will experience increased default rates during economic downturns. Similarly, investment firms use AI-driven models to simulate different market scenarios and evaluate how portfolios might perform under stress conditions. These simulations help financial institutions prepare for unexpected market disruptions and ensure that they maintain sufficient capital reserves. Artificial intelligence is also transforming customer interactions in the financial sector through automated customer service systems. Banks and financial institutions manage millions of customer inquiries each day, ranging from simple account questions to complex financial advice. Traditionally, customer service required large call centers staffed by human agents. AI-powered chatbots and virtual assistants are now able to handle many routine customer interactions. Natural language processing models allow these systems to understand customer questions and provide relevant responses. For example, a customer might ask about their account balance, recent transactions, or loan payment schedules, and the AI system can retrieve the information and respond instantly. More advanced systems can guide customers through processes such as opening accounts, applying for loans, or resetting passwords. By automating these interactions, banks can reduce operational costs while providing faster responses to customers. While automated systems handle routine requests, more complex issues can still be escalated to human representatives. This hybrid approach allows financial institutions to combine the efficiency of automation with the expertise and empathy of human staff. Financial forecasting is another domain where AI is playing an increasingly important role. Predicting economic trends, market movements, and financial performance is inherently challenging because financial systems are influenced by many interacting factors. Traditional forecasting models often rely on statistical methods that assume relatively stable relationships between variables. Machine learning models can analyze large datasets containing economic indicators, historical market data, geopolitical events, and even textual information from financial news and corporate reports. By incorporating these diverse sources of information, AI systems can identify patterns that may improve forecasting accuracy. For example, natural language processing models can analyze financial news articles, earnings reports, and social media discussions to measure market sentiment. Changes in sentiment can sometimes precede market movements, providing valuable signals for investors and analysts. In corporate finance, companies use AI systems to forecast revenue, manage budgets, and plan investment strategies. Predictive models can analyze historical financial performance and external economic factors to estimate future financial outcomes. These insights support better strategic planning and resource allocation. The growing use of AI in finance has also contributed to the emergence of financial technology companies, often referred to as fintech firms. These organizations leverage modern data analytics, machine learning, and cloud computing to deliver innovative financial services. Fintech platforms often focus on digital payments, peer-to-peer lending, investment automation, and personal financial management. Robo-advisors represent one example of AI-driven financial services. These platforms use algorithms to manage investment portfolios based on a client's financial goals, risk tolerance, and investment horizon. By automating portfolio management, robo-advisors make investment services accessible to a broader population at lower cost. Despite the many advantages of AI in finance, the technology also introduces new challenges and risks. Financial systems are highly interconnected, and errors in automated decision systems can have significant consequences. If an AI model is trained on inaccurate or biased data, it may produce flawed predictions that affect lending decisions, trading strategies, or risk assessments. Another concern is the potential for algorithmic market instability. If many trading systems rely on similar algorithms and react simultaneously to market signals, sudden price movements could occur. Regulators and financial institutions are actively studying these risks to ensure that automated systems operate safely within financial markets. Transparency is another important issue. Machine learning models, particularly deep neural networks, can be difficult to interpret. Financial institutions must ensure that AI-driven decisions can be explained and audited, especially when those decisions affect customers' financial opportunities. Cybersecurity also becomes increasingly important as financial systems rely more heavily on digital infrastructure and automated decision-making. AI systems themselves may become targets for manipulation or attacks, requiring robust security measures and continuous monitoring. Regulatory frameworks are evolving to address these challenges. Financial regulators in many countries are developing guidelines for the responsible use of artificial intelligence in banking and financial markets. These guidelines often focus on model validation, data governance, risk management, and transparency. Looking ahead, the role of artificial intelligence in finance is expected to continue expanding. Advances in machine learning, data availability, and computational power will enable even more sophisticated financial models. Real-time data analysis, personalized financial services, and predictive risk management may become standard features of future financial systems. Artificial intelligence is not replacing financial professionals, but it is changing the nature of their work. Analysts, traders, and risk managers increasingly collaborate with AI systems that augment their ability to process information and evaluate complex scenarios. The most effective financial institutions will likely be those that successfully combine human expertise with advanced AI capabilities. In this evolving landscape, artificial intelligence is becoming a central component of modern finance. It enables faster decisions, improved risk management, enhanced customer experiences, and more efficient financial operations. As the technology continues to mature, it will play an even greater role in shaping how money moves, how investments are made, and how financial services are delivered across the global economy.
If you find this video exciting, please like, subscribe, and turn on notifications. See you in the next AI for Beginners educational video.